Hi everybody, I think that's us live.
Brilliant. Hello. We're just going to hold off for a minute or two just to give people a chance to get in. I think with technology, it's very rare to start bang on time and have everyone there. So we're going to give people a couple of minutes if that's okay. There's a chat box function which you can ask questions throughout the presentation. So please, I encourage you to utilize that, and Michelle or I will come back to you with answers during the webinar. If there's anything at the end that we don't get through, then we'll come back to you post-event as well directly. But hopefully we'll be able to cover everything off, and hopefully you'll sort of leave with some really helpful information on investing in what is a really good market as well. So we'll hold off for one more minute, I think, and then we'll get started.
Yeah, I can see people starting to join in now, so we should be okay in the next minute or so.
Great.
Yeah, I think we're probably good to go.
Okay, brilliant. All right, well, listen, first of all, thank you so much for joining us. Thank you for joining Michelle and I for this webinar. So this is a co-hosted webinar between ourselves, Vantage Finance, and Grant Properties, and Michelle, who's a director there, and we'll let Michelle introduce herself shortly. The hope of today is a relatively brief webinar, I think. We don't want to take too much of your time, but we want to inform and introduce you to opportunity within potentially the more specialist investment market than you might be used to, how to maximize revenue on the HMO side, and the various ways of getting there through finance, sourcing property, and actually doing the work yourselves. I'm going to let Michelle take over, and I'll join back in at the end to talk about finance. And as I say, for any late sort of joiners, there's a chat box function. Please do use that to ask questions as we go along. One of us will get to them during the webinar. If there's anything we missed, we'll come back to you at the end. So Michelle, I'll hand over to you.
Perfect. Thanks, Joseph. So as you've heard, my name is Michelle Grant. I'm Investment Director at Grant Property, and I've been helping clients invest in the UK market for the last 19 years. So I'm going to start this morning's webinar by talking through a really short presentation that will touch on the UK buy-to-let market, highlight some key trends, and also talk about the effects of COVID-19. And then we'll finish the session by going over some questions that have been submitted from attendees throughout the webinar. But as Joseph said, feel free to submit anything as we go along as well. So without further ado, I will share my screen with you and we'll get started. Okay, everyone should be able to see the screen right now. So we're going to talk about maximising your buy-to-let potential. So first of all, I'll touch on what we do and why we do it. We'll then look at the different investment options that you may have been considering. We'll look at a case study, and then we'll come on to the fun bit. So please stay tuned until then. So what we do on behalf of clients is basically everything from start to finish. So we physically source the property on your behalf, we then renovate it, we furnish it, and then we do the ongoing property management. And the things that make us unique as a business is, first of all, that one-stop shop solution that we provide, the fact that we actually cover 10 cities throughout the UK. And we've been doing this for 23 years. And over those last 23 years, we've actually helped clients invest in over 2,500 properties. And clients actually help us grow as a business. So they help us grow by buying again and also by telling their friends. One of the most important things we actually do as a business is really understand your tenants and how we can help meet their needs. So tenants tend to seek properties in great locations that are in good condition, that are safe and affordable to rent, and also have low energy costs. So to that end, we've cut our CO2 emissions by 30% since 2006. They also want to work with a company that can give good service and also efficient repairs. So to that end, what we do as a business is we only buy properties in prime city centre locations, and we renovate every property to a really high standard. We put in those safety features and make them energy efficient. So we're actually helping clients by focusing on these low-risk properties, and being a one-stop shop, we're fully accountable at each stage of the investment process. And actually our buying power will save you time and money at the end of the day. So tenants refer their friends, which helps your occupancy, and investors tell their friends, which actually helps us grow as a business. So we'll come on now to looking at the different investment options that you may have been considering. The first one is, what type of tenant should I actually rent to? So this pie chart shows the whole of the UK, and you can see there the biggest percentage of renters is actually the student market. So students is actually our main focus to that end. They're a big and growing market. They're not very price sensitive, so it tends to be bank mum and dad. They're actually paying the rent on their behalf. And they're very low risk. And what we mean by that is that all of the students that we take on will be on one joint and several liability lease. And also on that lease will be their guarantor, which 9 times out of 10 is their parents in case there's any default in rent. Another sector that we're keen on is the young professional market. So they're also good, but they don't have guarantors. Corporate market is very small, so probably actually below 5%. Families are great, but they're actually much more price sensitive than students. And the social DSS market we see is much higher risk. So that's actually a market that we avoid renting to. The other thing you may be considering is, should I buy a traditional property or a new build property? And I have to say, over the last 23 years, we've never actually bought a new build property on behalf of clients, and there's a few good reasons for that. First one is that traditional properties tend to be in better city centre locations, whereas their new build counterparts can often be in the peripheries of city centres. In the traditional space, the room sizes tend to be much larger, and for those reasons, traditional properties tend to be easier to rent. Also, if you look back historically, the rental increases in the traditional space have been much higher than they have been in the new build space. One of the main benefits obviously of buying a new build property is that they have the lovely new build interior. So that's actually the main reason that we fully renovate inside. So with our properties, you get the benefit of a nice traditional building, but also the new build interior at the same time. If we were to look at prices in terms of comparison, new build properties tend also to be about 30% higher, as we're looking at price per square metre there. And in the traditional space, value increases, so your capital growth is definitely above market average. One of the things we're most proud of is that during the financial crisis, none of our clients were affected because they were in that traditional space, whereas we saw some landlords in the new build market see bank repossessions. That was definitely more common. And if we look at how long traditional properties are going to last for, then they've been around probably for at least 200 years and probably the next as well. The next thing you might also be considering is, should I buy in cash or finance? And also, should I be buying in a personal name or a limited company? And it can be quite complicated, it can be a bit of a maze, but we're actually here to help you navigate through that. So first of all, if we're looking at a cash investment versus finance, so we would say that if you're buying purely in cash, then your returns per annum over the last 23 years have been roughly about 11%. Conversely, if you're to put some lending in place at 75% loan to value, then your returns can be up to 28%. So obviously 11% is good, but 28% is much better. And to invest with us, we would say that you would need roughly about £100,000, and you need to put some lending in place with that. So for every 100,000, you can at least buy one property. If you were looking just to buy in cash, then that value would be closer to 250,000, 300,000. The next thing you might be considering is, as I say, looking at that buying in a personal name versus a limited company structure. Now, the government changed the tax rules a number of years ago, and certainly when I first started with Grant Property, everyone used to buy in their personal names. But now most of our clients actually use a limited company structure when they're purchasing. And there's a few reasons for that. So bank interest is deductible from income. They're easy to low cost and set up. So it can be set up during the conveyancing process. It takes a few £100s, it costs a few £100s to do that. And there can also be some inheritance tax benefits in terms of how you structure, perhaps looking at A-class and B-class shares for your beneficiaries. So going through all of that maze, the short answer that most of our clients, or the route that most of our clients take, is to put some lending in place, buy in a limited company structure, in order to get the highest possible returns and as low as tax as possible. The next thing we'll touch on is some case studies and what your money will buy you throughout the UK. So on the left-hand side, you can hopefully see some images there, and those would be the typical type of properties we would buy in Scotland. So you'd be looking at Georgian and Victorian flats. In England, conversely, we look at Victorian homes and worker cottages. In terms of price points, our most expensive cities would be the likes of Edinburgh, Glasgow and Bristol, prices up to about 250. And the less expensive cities would be your likes of Manchester, Birmingham, Nottingham and Dundee, where up to about 300,000 is probably your benchmark. Now the table on the right-hand side gives you an example of the different cities that we've operated in. And we've also put London on there just as a frame of reference, just so you can see the comparable to the other regional cities. So how do we do it? How do we actually buy in these prime areas? Well, the good news is that there's 3 sets of people who'll be looking after your interests during the buying process. So the first one is our buyers, which you can see a picture of up there. And we've got a full-time buyer based in every city that we operate in. Now, their job is to look at and assess properties that work both on and off the market. So you'll get to see opportunities that you wouldn't be able to find yourself online. Next, we'll have an independent RICS surveyor to confirm both the current value of the property, but also the value of the property after renovations. And that's really key to understand the numbers behind it all and make sure it's worth renovating up front. And last but not least, you'll have an independent lawyer to check the title deeds on your behalf. So how we assess and win properties. So our buyers would consider roughly about 100 properties each week online, on and off the market. They'll then physically visit 20 or 30 and put those through a buy-to-let model that's been developed over the past 23 years. We'll then offer on 10 if the numbers stack up, and we're lucky out of all of that if we win 1, because the competition is really fierce from other buyers at the moment. The main point of all of this is really not to drag you through the pain and only bring a property to you once we've done all the due diligence, once we've won it, and once we know it works, basically. As I mentioned briefly, there are supply shortages in the UK, so that is helping holding prices up just now. And as you see, property prices are going up, probably about 2.6%, I think, was the last Home Track report in terms of the overall UK picture. So looking at some case studies and how we physically create great properties. Now, this is a property in Edinburgh, actually, and you've got a large lounge, so you can see in the orange. You've got 3 bedrooms in the green, a big dining kitchen in the orange, and then a smaller box room you can see in the green as well. Now, what we want to do is to reconfigure that property. So what we'll do is we'll move the kitchen into the box room, okay? So we're creating an additional bedroom to the back. So from a 3-bedroom property, we now have 4 beds and obviously a lot more rent coming in. We'll give you a fixed price for the renovations, so you know exactly how much to budget for. And we do it very quickly, within 8 weeks. So in the background, our project manager is controlling everything from the joiner right through to the carpet fitter and everything in between. Now, the benefits of renovating is that the rent will go up because you've added more bedrooms. The value will go up because you've increased more bedrooms, and also the condition of the property. And also your ongoing maintenance costs are reduced because everything's brand new inside. So our renovations come with a full 12-month warranty, but you also get with that warranties on things like your boiler, which will be 7 years, and appliances, 2 years, etc. In terms of what we're physically doing during the renovation is everything from reinstating original features, new kitchens, new bathrooms, fuel central heating systems rewired, etc. So it's basically taking it all back to brick. And online, we've got lots of video eaters that we can show you some before and after renovations if you'd like to see them. So let's look at the numbers in a bit more detail. If any of you are familiar with Edinburgh at all, you'll recognise Marchmont Road. It's one of the most popular areas in the city to rent to students in particular. So this particular client bought the property for 300,000. We then spent just under 40,000 renovating it. The independent surveyor confirmed that after renovations, the property was worth 340, so it was worth doing those works. We managed to increase the rent from 975 to £1,700 through that reconfiguration. So the yields, if the client had bought on their own, would be about 3.9%, but through doing the works, we managed to get it up 53% to 6%. So massive return. The additional good news is that we increased our rents by about 10% this year. So the yield on this particular property is now over 12%, which is absolutely fantastic for such a prime area in Edinburgh. So once we've got your property up and running, it doesn't all end there. We also do annual health checks on your property portfolio. Now, those are designed to cover a few areas. The first one is to look at if there's any new HMRC rules that can be sometimes designed to trip you up. We also look at the value of your property on an annual basis, so hopefully give you a happy surprise and see how much money you've made. We'll also look at, is it time for a makeover? So if your property is quite a few years old, it might be worth spending some money on it to increase the rent and the value. And then last but not least, we'll look to see if it's possible to buy more properties with no extra cash in. So all designed again, just to help you through that maze. Now the question, I suppose, on everyone's lips is Brexit or COVID-19 an opportunity just now in the marketplace? So we've talked about the supply shortages, but house prices do continue to rise. And our verdict is that the short supply and very high demand is definitely driving more sense of urgency basically in the market. And especially with the stamp duty holiday, that's adding fuel to the fire too. So is it an opportunity? Well, what we are seeing in the market is that some sellers are holding off selling altogether. Some sellers are testing the market but won't discount. And there are some nervous sellers out there that may reduce the price. And we're more than happy to work with you on that to see if there's an opportunity to take advantage of that. But supply shortages are a problem. And for that reason, properties are moving very quickly. So we'd always say to clients, take some time out before you go live and ensure you are ready, because when you do decide to buy them, things can move pretty quickly. And when you are ready, we've got an online platform called Applecross Investments, and that'll help you see everything that's available and allow you to reserve any chosen properties. What we also do in the background is take a reservation fee of £5,000, and that just basically allows us to say to the seller that we have a serious buyer, and it helps prevent gazumping. So we're looking at managing risks. So property is a time-intensive asset class, as we all know. So our service is here and geared towards taking care of every aspect of that. Property prices can fall, and they did fall during the financial crisis, and they recovered quickly. And during that time, rents were always also rising. And interest rates could rise. I'm sure Joseph will touch on this, but the banks can offer fixed rates if that's something you're concerned about. And there are ever-increasing regulations in the buy-to-let market, but we're here just to take care of all aspects of that as a given. So at the end of the day, property is low risk and easy to understand. Now, if we look at our track record specifically in numbers, we rent out 8 out of 10 of every property before renovations are even complete. So our main aim is to get you income in the property as soon as possible. Our average occupancy is about 95%. I'm happy to say that as of today, we're sitting on 99% occupancy, which is great news for our investors. We've got 0 bad debts, especially on the student properties. And as I mentioned previously, rents are going up on average about 10% per annum. And your returns over the last 23 years are roughly about 28%. And we've got a financial model that shows all that I'm happy to share with anyone. And last but not least, and probably the thing we're most proud of, is that 98% of our clients would refer us to a friend or colleague. So if you are thinking of investing, then we're more than happy to introduce you to another investor to talk through their own personal experience with us. So in terms of next steps, this is what we call the fun bit, and this is what Joseph is going to come on to in a bit more detail. We do advise to select a bank wisely, and that's where people like Vantage Finance come in to help you through that. A lot of banks are still recovering from the financial crisis. So some key questions that Vantage Finance will ask on your behalf is making sure the bank will lend to the type of property that you want to invest in. So 3 to 5 bedrooms, that HMO space. Will they allow you to borrow to the renovated value? So that's also key. So what you want to do is make sure you're putting as less cash in as possible to the property. And will they lend to a limited company? Because that helps opens up the tax efficiencies. Can they do interest only? Because that'll help preserve your cash. And do they actually deliver in terms of the timescales required? And last but not least, what are their rates and fees? So these are obviously important, but they're tax deductible within that limited company structure. So the short answer, as we mentioned earlier, is look at lending, look at the limited company structure to get the highest possible returns. So just to summarise, the UK residential market is a low risk market and it gives high returns. Supply shortages are driving prices and rents, and traditional property has historically outperformed new build. So that's the end of my short presentation. It's all about thanking you for investing, for reinvesting, and for telling your friends. What I'll do just now is I will stop sharing my screen and I'll hand over to Joseph to talk a bit more about the lending side.
Brilliant, thanks Michelle. Just a reminder, any questions, the chat function's open, so feel free to share those now or contact either of us directly after the presentation as well. That's absolutely fine. So let me share my screen so I can talk about some of these finance options for you. I'm hoping that's come through okay. So I'm going to start by giving you a tiny little background on Vantage Finance, if that's okay. We are a well-established brokerage in this space. So we've actually been going for around 16 years. We've always operated in the specialist sector. So although we are a typical mortgage brokerage that can support you on Mr. and Mrs. buying a property to live in, actually our key area of focus, and probably more importantly, our key area of expertise lies within investment property in a number of forms, which I'll come on to. As a business, we are regulated, we are authorised by the FCA and have been for 14 years. And we've actually been part of a larger specialist lending group coming up to 3 years now. What that's given us is some strengthened board governance, deeper roots in the industry. And probably the biggest benefit is one of the businesses within our group is actually one of the lenders, is a bank. And what that gives us is a closer market insight by hearing what's going on their side, and also a little bit of room to lean on them to get things through that maybe couldn't against their criteria in black and white. So some real positives there. What is it that we do specifically? So I'm going to come on to how we can support you with a view to investing through grant properties and into the HMO market. But actually our wider service offering, we deal with buy-to-let mortgages, normal, standard, as well as the complex, bridging finance, commercial loans and commercial mortgages. We deal with full development finance as well, whether it's a single unit or a larger development. We deal with second charge mortgages, sometimes known as secured loans. That's across both investment property and your main residences. And we deal with first charge mortgages as well. As I say, an area we can support on, although we advertise ourselves as a specialist master broker in the industry. The master broking term comes from the fact that actually a lot of our business is brought to us through other mortgage brokers, where this is a little bit beyond their expertise and outside of their core business. It's an area that we thrive on. So we want to support you across that if we can. So talking about the products, now I'm going to keep this very, very simple and talk about the two types of finance that realistically you would look to utilize by investing through grant properties or into this market with a refurbishment model to maximize your earning potential. The two key products in the market that you're going to look to use are something called a bridging loan or bridging finance and a buy-to-let mortgage. Now, I'm going to start at the bottom because ultimately we want to get you onto a buy-to-let mortgage on this property. You can typically raise up to 75% of the loan to value. There's an asterisk there because there are lending options up to 80% or 85%. Some brokers will throw that at you as a headline rate. Very difficult to achieve, particularly tough in the HMO market. And realistically, I'd rather set expectations that you can look up to taking 75% of your property value out as a loan. There are cheaper rates in a term loan in the buy-to-let market, which is good for you and for your investment. You can look at an interest-only model, which Michelle touched upon earlier, maximizes your earnings on a monthly basis because you're not paying down the debt, or you can look at a repayment option. And ultimately, the fact that it's a term loan makes it more attractive. It's a longer term commitment with cheaper debt, so that you can maximize your revenue while investing in this market. Now, with these properties, a lot of lenders will look at their investment. I think if we take a step back from technical terms, lenders will look at a deal from a viewpoint of risk. How risky is lending on a property? Now, a risk to a lender lending on a property day one on a term loan that you're planning on stripping out, remodeling, getting people in at a higher value is there's no guarantee you're going to succeed. So actually, a lot of these properties become, due to your plans, unmortgageable. And in that instance, there's a product in the market called a bridging loan. Now, depending on your experience in the market, you may have quite negative connotations about the term bridging finance. That's because in years gone by, and I'm going back quite a way now, bridging finance was incredibly expensive. It was a product that was created to quite literally bridge the gap between a sale and a purchase so that you didn't miss out on buying your dream home because you hadn't sold yours yet. It was an expensive short-term loan. Now, it's a commonly used loan in the market, particularly for property professionals, investors, developers. And funnily enough, last year, the biggest use of a bridging loan, it was almost 30%, was for property investment and refurbishment, as per the model that Michelle has talked you through so sort of effectively. Sometimes it's known as a short-term loan. A lot of lenders like to get away from the term bridging, but we're going to stick with that for now. So what are the benefits? Where does it work? So it's a short-term loan, very quick to be released. So if you're moving quickly on a property that is going to go, bridging loans can be done in theory within a week. I think that's overselling it slightly, but we have case studies, as most brokerages should do. But an average time for a bridging loan should be within a month. We should be start to finish securing finance for that and having funds released. The pricing is higher. That is absolutely a feature of a bridging loan, and I'm going to come on to that on the next couple of slides about how that looks. Crucially, you can secure bridging finance against what other lenders may class as an unmortgageable property. A property that is potentially derelict, that is underserved, the kitchen might not be functional. All of these examples are reasons why a typical bank or a typical buy-to-let lender would not lend on a property. But it doesn't make it a bad property, and it doesn't make it a bad investment. Bridging finance can be the solution. Again, you can lend up to 75% loan to value. And the point above, you can sometimes borrow against the purchase price as well as the costs you're planning to put in. And with some lenders, you can borrow against what we would call the GDV, which is the gross development value, the end value once the works are done. The asterisk is there because in this market right now, it's rarer, and therefore you're going to pay a premium to take out a product of that model. As we move on, I'm going to talk about pricing in the more traditional model, which is borrowing against purchase price and purchase value, market value. Before I go on to pricing, it's really important to talk about how is it best to work with a broker, us or otherwise. And for me, it's all about setting our expectations early. There are only ever 3 key drivers for a client or a borrower in my mind. You are either driven by price and you want the cheapest rates possible. You either need the deal to happen quickly, or crucially, it's a great property, I just need an option that's going to happen. There's something complicated about it. There's a quirk. There's something maybe in your profile as a borrower. Maybe this is your first property in general. You're not a homeowner, and therefore we just need a deliverable option. Whatever that is, have that conversation up front, because it will impact the way that we attack the market to find you the best lending option as we then move forwards to purchasing the property. So pricing. So I'm going to talk about sort of average pricing here, and actually what can you expect to pay, and give you a little range. If you want to have a specific conversation about property, about pricing, about your profile, feel free to pick that up in the chat box or afterwards. So let's start with the short-term loans. If you are needing to take out bridging finance to purchase a property, this is what it might look like. Typically, you would take a bridging loan out for between 6 to 18 months, 12 months being the market standard. And crucially, you need a strong exit plan. That's the key feature of going into a bridging loan. How are you going to get out of it? With grant properties, it's very easy. The refurbishment is laid out at day one, as Michelle's already spoken about, and you've got a rock solid exit with hopefully pre-lets in place that we can take you onto a term loan. The feature of a bridging loan is that the interest is charged on a monthly basis. So those rates that I've shown you there and highlighted, if I start with the top rates, the 0.79% would be a monthly interest rate charged on the debt that you've taken out. And that's if you're doing light refurbishment, painting, fitting maybe some new kitchen tops, but not a full fit out, decorative rather than structural. Adding walls, stripping walls, knocking through generally would be classed as heavier refurbishment, which you'll pay a premium for, which is understandable. So to take out maximum borrowing on the bridging side, you'd be looking at pricing around 0.79 and around 0.85% a month. If you're willing to borrow a little less, that rate drops fairly significantly to 0.65 and 0.85 accordingly. Now, to some, that can be quite scary. If we look at that over a 12-month term, if I look at just the 65% numbers there, you're looking at 7.8% for the year with a light refurbishment, or it's 10.2, I believe, on the heavy refurbishment side. That might sound expensive, but the beauty of a bridging loan is that there are no exit penalties. So if you take a bridging loan out for 12 months and you actually clear the works within 3, as long as we can support you on securing your term loan quickly, which actually as a brokerage, our stance is that we start looking at that at day 1 or before the bridge is released, then we can exit the bridging loan with no penalties. So you'll have only paid that interest rate for the 3 months you've taken the loan out. So yes, it is an expensive loan if you need to keep that loan for 12 months or beyond. But actually, with a good partner, with good project managers, with the Grant Properties in your, on your bench, realistically, you shouldn't be taking out that bridging loan for much longer than 3 to 4 months, I would say, and I would certainly hope. How does that then transpire into the term loans? Well, comparatively, the rates are a lot lower. The rates that I'm focusing on here are for the HMO market. So houses of multiple occupancy have bigger returns. It's a very attractive market. It's why Grant Properties put such a focus on that as well. And naturally, banks will charge you a premium for the fact that you're earning more on a property. Sadly, it's the way it is. So looking at a few options here and explaining what this might mean. The first option, if you are an experienced landlord, if you have another property and you've owned it for more than 2 years, these are the sorts of rates you're looking at. To remortgage day 1 from either a cash purchase or you have a bridging finance in place, we're looking at rates between 3.39% and 3.99%. That range is based on you taking either a 2-year fixed period of those rates or securing the rate for a longer 5-year period. And the range obviously goes from a 65% loan to value all the way up to maximum borrowing, which would be 75% in this instance. My personal opinion, my personal comment on this, having been working in this space for a number of years, anything under 4% for a HMO is a really competitive rate, in truth. These are really interesting and it's a good time to be buying in this market, and your yields are generally 6% plus as a minimum. So borrowing at 3-point-something% on a portion of that value of that debt is quite an attractive prospect. The second line down, the 6-month remortgage options, you can secure cheaper finance at the higher loan to value if you're willing to keep the property for 6 months, either through cash or with the bridging finance in place. So a day 1 remortgage limits your lending options, but the pricing is still pretty good right now. Waiting 6 months widens the bucket, if you like, of lenders that will lend to you and can bring the rate marginally down. But we're talking marginally, so something to consider for you. If you're a new landlord, if this is a first-time investment for you and you're diving into the HMO space, typically that would be quite expensive. It's a very specialist type of property, and lenders like to see a track record. We have a rate available with one of our key lending partners of 4.74%, which is the best you're going to get, really. They wouldn't usually offer that rate to a first-time landlord, but they will through us and for a Grant Properties client. So that is an exclusive. So that is your worst case scenario entering the market if this is your first investment. And the good news is that when you come to remortgage, even if you take a minimum fixed period of 2 years, you're down to the cheapest rates possible, and you've opened up the market because you are then an experienced landlord with a track record. My advice to anybody that works with us really is get into this game for the long game. Actually, short-term property investment is difficult, and really you need to develop from derelict to fancy and sell high. Actually, buying property to retain, the rates shouldn't be the key driver here. It's finding good property and securing the finance on it. And those rates are pretty good. For context, to give you the other side of the coin, the worst possible rate that we have available right now that we're delivering on buy-to-lets and on HMOs is 6.99%. So again, that sounds expensive, but actually it's not a deal breaker for a great property. And that's your worst case scenario. We're not putting that out very often at all at the moment. Key messages from me. What I want to leave you with on that: lenders are lending. The market is strong, funnily enough, through this year, which has been very difficult for a lot of businesses, a lot of industries, everybody across the country. Us as a brokerage, buy to let has been an area that has really held strong and held true. And we've been really keen to support the lenders that are still lending on that front. You've got a variety of fixed terms. You don't have to commit to one of these mortgages for 5 years plus. You can commit for 2 years, or you can take out a variable loan. So if you think the market could get even cheaper, feel free to dive in on a variable rate, or we can lock that down for you for 5 years. Some lenders will go as high as 7, and you can really map out your earnings over the next 5 years plus in a really concrete way. And finally, there is real opportunity to earn in this market. It's a specialist market, it's complicated, but actually with partners like Grant Properties, and if we can support you on the finance side, we'd love to. There's some real money to be made, and it's a great place to be. My contact details there, as are our managing director Lucy, who's heavily involved with the relationship we have with Grant Properties. I'm happy to send this out as well, sort of post-event, so that you'll have these, so I won't leave it up for too long. And if you do have any questions, please flag those in the chat box now, or come back to us at a later point.
Perfect. Thank you very much, Joseph. So I'll now just share some questions that actually have been submitted prior to the event. So the first one we have actually is for you, Joseph, and it says, is there lending available in a limited company if I'm retired?
Yeah, so it's a really interesting point. The simple answer, straightforward answer is yes, there is. Truth be told, retirement buy-to-let lending is possible. Lenders look at the asset more than they look at you and your profile. Most lenders will have a maximum age limit that you would need to be at the end of your term. Most buy-to-let terms are a 10-year term. So if their maximum age is 80, 85, you can look at buy-to-lets all the way up to sort of 75. In a limited company, it's easier because the limited company owns the property, and ultimately, regardless of what happens to you, that company can be held accountable and the property can be reclaimed, so the risk is lower. So in short, yes, absolutely. We see a lot of retirement investment for later life earnings.
Thank you. The next one is for me actually. So it's how much cash would I need to invest with you? And simple answer is minimum is really £100,000. And with that, you'd be looking to take some lending in place, some lending with that. If you're looking to buy purely in cash and not take lending, then anything between 250, 300 would be the sweet spot. The next one is also for me. So it's which cities are performing best at the moment? And that really, I suppose, comes down to two things. If we're questioning, is it a capital growth play or is it a yields play? So some of our cities is definitely more of a yields play. So the smaller cities like Dundee would be up there. And if we look at cities like Nottingham and Manchester, for instance, and Edinburgh, I'd couple with that, from a capital growth, are definitely up there as the best ones. And the next one's for you actually, Joseph. So it's if I buy a property in cash, how quickly can I refinance?
So we see a lot of cash buyers looking to then take money out once work is complete. Again, the answer is very similar to the options I put on the screen earlier. There are lenders that will lend on day one remortgages. You can buy property in cash and remortgage at day one. You open your lending pool up wider if you own the property for a minimum of 6 months. So you can do it from day one. You can potentially get a cheaper rate a little bit later, but it's worth having that chat and we can hatch a plan together.
Thanks. Well, if there's no questions actually coming up in the chat box, then that probably brings us to the end of the webinar today. So thank you very much, everyone. Hope you found it useful and informative. You will receive a follow-up email from us with our contact details in it. And we'll also pop on there something called an investment challenge. It's just a little survey monkey. So if you're interested to find out more about how Grant Property or Vantage can help you on property or the lending side, then just fill that in. We'll get back in touch. But thanks so much, everyone, and have a good day.
Thanks for joining us.
Thank you. See you later. Bye-bye.